Hello and welcome to the IFRS 17 training series. In this video, we will cover investment components. So what is an investment component? IFRS 17 defines it as the amount that an insurance contract requires the entity to repay to a policyholder even if an insured event does not occur. And we need to distinguish between distinct and non-distinct investment components. An investment contract is distinct if and only if both of the following conditions are met. First, the investment component and the insurance component are not highly interrelated. And secondly, a contract with equivalent terms is sold or could be sold separately in the same market or the same jurisdiction, either by entities that issue insurance contracts or by other parties. For non-distinct investment components, we need to consider the following. An investment contract and insurance contract are highly interrelated if the entity is unable to measure one component without considering the other, and the policyholder is unable to benefit from one component unless the other is also present. For non-distinct investment components, IFRS 17 applies, and we need to project cash flows under IFRS 17, and we should include the non-distinct investment components in those cash flows. However, we do not record the investment components on the income statement, so they're excluded from the insurance service result. They're not included in our insurance revenue or our insurance service expense. Instead, the activity, the actual versus expected, is recorded within the CSM roll forward calculation. Another interesting thing is that IFRS 17 requires insurers to split the actual and expected payments between the insured event amount, the death claim, and the investment component amount. For example, say the cash surrender value. So for example, say you had a final expense product that paid out a death claim of $15,000. But at the time of death, if that person was instead alive and could surrender or lapse their policy, they might have had a cash value of $8,000. So at the time of death, $15,000 was paid. But in any other scenario, because the policy's lapsed, they would have received that $8,000. So realistically, the death amount is only the $7,000. So what's required is the $7,000 amount, the 15 minus the 8, would be recorded as a claim, and then the $8,000 amount would be recorded as an investment component. So companies are required to split death claims that have investment components, non-distinct investment components, into two components, the insurance part of the amount and the investment component amount. The following tables will show examples of investment components in Canadian contracts. And the first one we'll talk about is cash surrender value. And this is an investment component and it's not distinct. For CSV, we would include the cash flows in our fulfillment cash flows, but we would exclude the effects from our insurance revenue and insurance service expense. And again, we're going to reduce our death benefit by the implied CSV and only record that reduced death benefit in the insurance service expense, whereas the CSV would go into the CSM roll forward into the investment component part. Next, for endowment benefits, these are investment components and they're not distinct. And again, we're going to include them in the fulfillment cash flows, but exclude them from insurance revenue and insurance service expense. Now, what about policy loans? They are not an investment component, so therefore we don't need to decide if they're distinct or not, and they will be included in the fulfillment cash flows, but they are excluded from insurance revenue and insurance service expense. And instead of reporting the balance of a policy loan as an asset on the balance sheet, we're actually going to record it as a negative liability and include it with the insurance contract liabilities. Another contract feature in Canada is the return of premium on surrender or return of premium on expiry, and this would not be considered an investment component, and we would include it in fulfillment cash flows, but we're going to exclude it from the insurance revenue and insurance service expense because surrender is not really an insured event. For return of premium on death, this is again not an investment component, and we would include it in the fulfillment cash flow, but this time we would include it in the insurance revenue and insurance service expense because death is an insured event. Next, we'll talk about the account value less surrender charges. This would be an investment component, would not be distinct, so therefore include in fulfillment cash flows, exclude from insurance revenue and service expense. What about policyholder share of the underlying for VFA contracts? Well, this would be an investment component. It's non-distinct, so include in fulfillment cash flows, exclude from insurance revenue and service expense. How about experience rating? Well, yes, if it's paid in all circumstances. So this would be the same as the policyholder share of the VFA. If there is no insurance risk, i.e. a hold harmless agreement, the contract would be outside of the scope of IFRS 17. But if there is, then it would be in scope. Next, we'll talk about amounts on deposit. These would be considered an investment component, and whether they're distinct or not depends. If they are distinct, then they would be separated from the insurance contract and measured under IFRS 9, and the liability would be included as an other investment contract liability. If it's non-distinct, then IFRS 17 would apply, and the liability would be included with the insurance contract liabilities, but they would be excluded from the insurance revenue and insurance service expense. How about annuity payments during the term certain period for a life contingent annuity? So think of a life annuity that has a term certain period of, say, 15 years. For those first 15 years, if a person dies, they would get their remaining payments paid out to them. After 15 years, if a person dies, there are no further payments. So for those first 15 years, those payments are actually investment components. If they lived, they would get the payment. If they died, they would get the payment as well. So it's an investment component. And it's non-distinct. So for during this term certain period, you would include those cash flows in your fulfillment cash flows, but you would exclude the payments from your insurance revenue and insurance service expense. But after the term certain period, they would not be an investment component anymore, and they would be included in your insurance revenue and insurance service expense. How about prepaid premium accounts? They are investment components, and are they distinct or not? Well, that depends. If they're distinct, again, you separate from the insurance contract, measure under IFRS 9, and include the liability under other investment contract liabilities. If non-distinct, IFRS 17 applies. The liabilities included with the insurance contract liabilities, and you'd exclude the cash flows or the result from your insurance revenue and insurance service expense. And finally, claims fluctuation reserves. These are investment components, and again, it depends if they're distinct or not. If distinct, IFRS 9 applies. Other investment contract liabilities is where it would show. If non-distinct, IFRS 17 applies. You include it with the insurance contract liability, and you would exclude the result from insurance revenue and insurance service expense. Now let's talk about the financial statement treatment of investment components. So for non-distinct investment components, these do not impact the income statement or statement of financial performance. So right now under IFRS 4, you might see a line for death benefits, and then you'd see a line for investment components or cash values paid. Well, under IFRS 17, the death benefits will still hit the income statement, but the investment components will not. And instead, they'll impact the CSM roll forward calculation. And any variance in the actual to expected investment components are deferred in the CSM and recognized over time. So if you watch our video on the general measurement approach, you'll see the CSM roll forward in the period, and highlighted in red here is the effects of our investment components. So instead of hitting the income statement, the expected investment components relative to our actual investment components will actually adjust the CSM. So from our example in the GMA video, we had expected investment components of 30,000. So say expected cash values of 30,000. Our actual cash values were only 25,000. So that $5,000 difference will increase the CSM, and it'll be deferred over time and released into income over time instead of hitting the income statement today. So that concludes our video on investment components, and thank you for watching.